So imagine a stock offering you a 5% yield with a PE ratio under 20 and a sexy narrative. Sounds too good to be true? Well, maybe. I know that you're looking for undervalued stocks right now, and today I want to show you how those 4 companies sounds like the perfect deal, but they're actually very bad investment. And I'm going to walk you through the analysis to spot those company that seems too good to be true. And you know, there's no free lunch in finance, so when it's too good to be true, it probably is. All right, so let's get started with Campbell's CPB forward PE ratio of 12.35 with a yield of about 5%. What's the narrative for this one? Well, the company has 2 segments, food and beverages, operating a bunch of iconic brands such as the Campbell Soup, the Goldfish, I love the Goldfish, Prego, V8, and on top of offering those products into grocery stores, they also have their food service division offering those products and recipes as well to healthcare facilities, to restaurants. So wide distribution network, iconic brand, consumer staple, everything looks good, right? Well, here's the kicker. Let's take a look at the dividend triangle now that we can found out dividend stocks rock, where it consists on looking at the revenue growth, the earnings per share growth, and the dividend growth. When you look at those 3 metrics together, you see if a company is in good health and its ability to continue to thrive in the future, despite if you have a sexy narrative or not. So for Campbell's, well, we see first that the revenues are pretty much growing besides a small moment between 2018 and 2020. Everything else seems good. So we have a company that is growing, and usually the playbook for this type of business is to grow by acquisition, acquire more brands, introduce them into their network, and just benefit from it. Well, the benefit from it part has been a big failure. When you look at the earnings per share graph, you will see that since 2022, it's downhill. I mean, it's no surprise that the stock price keeps going down if the earnings are going down. The company is having trouble maintaining healthy margin. Probably that costs are too expensive. Inflation took a hit as well. But unfortunately, this is not a good sign. The other thing is, despite the recent dividend increase at the end of 2024, we see that it's not a consistent dividend grower. For all those reasons, I would stay away from this one, especially thinking that right now we are in a great bull market. It's been 3 years with double-digit returns, and Campbell seems unable to increase their margin and make more profit as revenue grow. So this is a very important point. When you look at the revenue going up, but the earnings are going down, there's definitely a major problem inside the business. All right, so now let's move on to the next one. Transcontinental, TCL.A.TO, forward PE ratio, even a better deal, 7.55, definitely undervalued, right? And offering a 4.6% yield. So the narrative here, well, Transcontinental is kind of like 2 businesses together. The first one, kind of like a secular dying business, printing media. Think about flyers, think about magazines, think about the things that we don't use anymore. However, very solid business, even though it's in secular decline, and it generates a lot of cash flow. The interesting part, though, is Transcontinental made a big switch several years ago, around 2019, where they made an acquisition to offer packaging products. So now you're thinking e-commerce, delivery, there's all about packaging, so it's going to grow very fast, right? They even paid a special dividend not too long ago this year, so everything seems to be rolling, right? Not so much. Pulling out the dividend triangle again, so as you can see, you have to make the link between a great investment thesis and the metrics, because if the metrics don't back your thesis, you're just in a fairy tale. The revenue, big jump in 2019 after the acquisition, and after that, nothing. Just struggling after struggles just to find a way to grow the business. When one part of the business is growing, the other part is dragging it down, and overall, the company has never been able to grow their revenue since 2019. In terms of earning per share, we do see a rebound in 2024 to 2025, but it's about time, right? Because it's been a long path to hell. And the last thing that I see on the dividend triangle chart is, besides the special dividend that was paid earlier in 2025, no dividend increase since 2021. We are in a bull market, the economy is still doing well, and yet Transcontinental is not able to maintain earnings growth and dividend growth. What do you think is going to happen next? Well, probably not something great. So yes, it has recovered a little bit since 2024, but we're definitely very far away from the peak price in 2018. So after those two examples, you can tell that whenever you pay not much for something, well, you get what you paid for. So if it was cheap, probably the company shows some problems. If you want to start your research on the right foot, I suggest that you download the Dividend Rockstar list at dividendstocksrock.com/rockstar. Why? Well, quite simple. It is a huge lineup of Canadian and US stocks that shows thriving metrics. So positive revenue growth, positive earnings growth, and positive dividend growth. In other words, a thriving business that is able to increase their sales, increase their profit, and share the wealth with shareholders. So download it for free at dividendstocksrock.com/rockstar, and we update this list every single month. All right, let's move on to the next one that is even more interesting. Western Union, WU, forward PE ratio of 4.55. So you get this one for basically nothing with an amazing yield of 11.75. So 12% yield, super low PE ratio. And when you think about that, well, we all need to transfer money at one point or another, especially with Western Union that is present across the world in pretty much all countries. So cross-border volume, they get a fee on that. It's like a toll road. Everything sounds amazing. But when you look at the dividend triangle, this story doesn't hold for 1 second. What you see here is revenue keeps on going down and down and down and down. Again, have to tell you, if you want to look at Visa and MasterCard while they process payments, the revenue keeps on going up double digit. This one is going down double digit. In terms of earnings, quite shaky, sometimes up, sometimes down, but absolutely no way to have something stable. And you got the ultimate proof here. The dividend stopped being increased in 2021. So 4 years with no increase, declining revenue shows a lot of struggles, and then shaky earnings. I mean, no wonder that the company has been seeing its stock price going from $30 to less than $10. I don't expect much from this one, even though there's a quite interesting narrative. Be careful when you go for high yield stocks that shows such a low PE ratio. So let's go down for the last one, but certainly not the least. I actually had this one in my portfolio a while ago, did very well at the beginning and ended up in a major loss for my portfolio. Andrew Peller, ADW.A.TO, forward PE ratio at 10.30. So again, super undervalued, offering a yield of 4.8%, so almost 5%, and used to be a Canadian dividend aristocrat. So this one is a producer and marketer of wine, biggest one in Canada. Huge distribution network, used to grow by acquisition, which totally makes sense once you have a wide distribution, right? So you acquire vineyards, you sell it, you can import, you have the network, you dominate the market, everything goes well. Actually, that was my thesis back in 2017 when I bought the stock. As you can see now on the dividend triangle, I was right at first. So in 2018, it did very well. It jumped as the company continued to grow by acquisition. After that, well, nothing. And that is the problem. They had stopped making those acquisitions, and organic growth has been family, has been nothing, actually sometimes declining even worse, right? So year after year, the company pretty much maintained the same level of revenue, but the earnings per share started declining and declining and declining, even reporting losses from time to time. So definitely not in a good place. And another one that stopped increasing its dividend in 2021. Yet, since 23, The market is on fire, but this one still struggles. Higher cost of marketing, higher cost due to inflation, and then no sales growth. That is a really bad combination. So it went from a small cap with a lot of growth perspective to something that has not much to offer. So in conclusion, when you look at those four companies, one thing that is really important is when you see a company offering you a low P ratio, so it seems undervalued, especially right now where everything trades above 20 times the earnings, ask yourself some questions. Maybe you're going to find great deals. Sometimes it happens, but most of the time when you look at the metrics, there's a reason. The market is just not willing to pay more for a business that is struggling and can't find a way to grow their earnings and grow their dividend. Again, if you want to find companies that have a completely opposite profile that are thriving and showing great metrics, download the Rockstar list at dividendstocksrock.com/rockstar. All right, next week, we're going to talk about something quite interesting on the keen market. Unicorns. So company showing a yield above 3%, but showing also high single digit to double digit growth perspective. Can they exist? Well, I found 3. To make sure to not miss that video, do not forget to like this video, subscribe to the channel, and we're going to talk again next week. Until then, don't forget to stay invested.